For nearly 4 decades, Moore's Law has been the governing dynamics of the computer industry, which in turn has impacted every industry. The exponential performance increase at constant cost and power has slowed. Yet, computing advance has gone to light speed. The warp drive engine is accelerated computing, and the energy source is AI.
Coming up on today's review, stocks finish higher on the back of comments from Jay Powell, trouble at regional banks, gold hits new all-time highs, and Nvidia's on the path to becoming the world's biggest company. Hey, what's up everybody? Welcome back to the Click Capital Daily Market Review. And it was another bullish day across the board, except for 5 stocks of the Magnificent 7, finishing a bit lower today, led by Tesla. Meta's still holding up good, and the clear leader today was semiconductors and Nvidia, which I'm going to get into in a bit. But all sectors had a good day today. Industrials, utilities, financials, healthcare and consumer defensive. So looking at the S&P 500 was a low range day. Markets coiling up going into the jobs report on Friday. Volatility still staying a little bit as well. And so overall the market's holding up pretty good. We can see that in the Russell 2000, which is probably the most diverse index out there and best broad representation of the US stock market. Also looking at the percentage of S&P stocks above the 200-day average. That's looking healthy as well at 74%. Holding up. However, the leadership in this market has clearly changed, with Apple no longer the most important stock in the market, with it falling again today, getting down to 168 on a bit of a slide here. Microsoft's still the biggest stock in the market at 2.99 trillion. However, that's been consolidating for a bit over a month here. Alphabet's been sliding lower as well, and the previous hottest stock in the market, Tesla, has been in a persistent downtrend as well. And obviously what's clearly different is the most important stock in the market now, Nvidia, with its ascent higher, seemingly getting steeper by the day, with it looking almost certain we're going to hit that big psychological $1,000 a share, with it only being 12% higher than where it's trading now. And so the Magnificent 7, which traded pretty closely as a group for the last couple of years. They all ripped into 21, came off hard in 22, recovered all that lost ground in 23. Been quite the divergence this year. And there's been a lot of new names being thrown around that they're no longer the Magnificent 7. Some are saying it's the Super 6, the Fabulous 4. However, I think you could take it all the way to the Holy One, Nvidia. And looking at that chart, doesn't look like it's putting in any sort of topping formation. Looks to be in a really strong momentum run. And that's the market likely getting excited by Nvidia's AI conference, set to start later this month on March 18, where no doubt Jensen Huang will work his magic, get everyone super excited. And thanks to huge capex spending by the biggest companies in the world like Meta, acquiring 350,000 of their signature H100 GPUs, he's got the numbers to back it up. And so they're in the perfect place at the perfect time, already making them the 3rd largest stock in the world. Not too far behind Apple now. Microsoft's still a little bit out in the front there. And that's thanks to the fact they can sell their graphics processing units, GPUs, for really high prices. Some of them going for $40,000, allowing them to have huge 90% plus gross operating margins because they absolutely dominate the market. And they initially came out in the mid-late 90s with GPUs for gamers, as they're originally designed to help process graphics. And so they're made up of many more smaller cores compared to the CPUs. They're really good at processing large amounts of data. And so it wasn't too long ago, companies figured out they're really good for running AI models, since large language models have to process a lot of data really quickly. GPUs are perfect to power them. And so every company is trying to incorporate AI into their businesses, into their apps. So they kind of got no option but to buy all these GPUs from Nvidia, and they actually can't make enough of them. And so we very well could see Nvidia become the largest stock in the world. Who knows, maybe in the next couple of weeks, or we may get that overdue short-term pullback, and then it goes on to it in a few months later this year, with some bullish arguments like Apple became the largest stock in the world for over 10 years due to dominating the smartphone market. And some estimates the mobile economy contributes about 4.4 trillion to global economic output, whereas the AI market could grow to as much as 15 trillion. And Nvidia is obviously the dominant leader in that, and has wide use applications of their products from data centers and even other things like the metaverse and self-driving cars, of which Apple just abruptly announced they exited last week, adding further sour sediment to the stock. And so there's a 10-year monthly log chart of Apple, currently at 2.6 trillion, with the chart not looking too exciting here in the last couple of years, consolidating at best, if not topping. Microsoft looking a little better there, even though it's consolidating the last couple of months, just sitting below 3 trillion in market market cap. Switching over to Nvidia, this thing's still lighting up on a run, and it only has to climb another 35% to reach $1,200, and then it'll officially be the largest stock in the world. And whilst 35% may sound like a lot for a normal stock, we all know Nvidia is anything but normal. And since the AI boom is so big, I would say it's almost destiny that it does become the biggest stock, potentially in the next couple of weeks, if not maybe after the next pullback we have, then later on this year. Because just like Cisco in the late 1990s, with the internet boom, and them being the dominant leader in hardware, software, networking, all types of internet solutions. Just looking at the Cisco 1999 annual report, their sales and income was on fire as well. And they did a great job really latching on to the internet boom, hyping up investors, getting really rich valuation, and briefly overtook Microsoft as the largest company in the world. And so you could kind of think of that as the pinnacle of a boom in the bull market. When the hottest stock becomes the biggest stock in the world, there's nowhere else for it to go. It's already reached the top. It's captured the white flag. Everyone else is racing to catch up to them. Unfortunately for investors, Cisco came off super hard the following 3 years, falling more than 90% peak to trough, as all the hype and optimism came out of the general market and Nasdaq as a whole, not to mention an onslaught of competition came in and inevitably compressed margins like it does in every industry after a boom. And here we are 25 years later, and Cisco is still trading below those crazy late 1999 highs. And this AI hype is spilling over to all other speculative areas of the market, like cryptocurrencies. Even Michael Saylor's pump and dump vehicle, MicroStrategy, been on a tear these last couple of months. However, it too is still well off. Those late 1999 highs, he managed to pump the stock up back then. And just like back then, he's offloading shares to gullible new investors. Believing in his pipe dream, just the last couple of days he's already offloaded over $10 million worth of stock, and anytime we rip up, he's going to offload millions of dollars to you if you want to buy it from him. And so don't get me wrong, I'm not saying Nvidia is definitely going to go the way of Cisco, and definitely not MicroStrategy, run by the pump and dump king, Saylor himself. Nvidia is an actual company with real revenues. It's definitely not cheap, but insiders are starting to sell into it. A little bit here, not a whole lot, and we haven't seen Jensen Huang show up in insider transactions for a few months now. Last time he was selling was back in September, and so he definitely doesn't want to sour sediment. It's probably letting it rip here. But I'd say once we hit $1,000 a share, or that $1,200 a share, and it becomes the biggest company in the world, he'll probably offload into that, and that could actually mark the top, at least in the short medium term, as the rate it's climbing now, simply unsustainable. No stock in the history of the world has ever sustained these advances for years and years. And like I said, he's waving that big white flag to everyone who are already coming for him, including his own customers looking to build their own chips. Not to mention the Chinese, who are working like crazy to compete with Americans in the semiconductor business and not rely on them. But no doubt they're going to remain out in the lead for some time yet. It's just that the stock price could be getting somewhat detached from even the hugely growing business it represents. And so in almost 2 weeks, we'll get the AI conference from them. We may continue running into that. Could see $1,000 plus a share, may be a little bit of a sell the event, but it may only be a short-term pullback before it continues on to $1,200 a share later this year. Also adding fuel to the fire is the big kahuna himself, saying there's no near-term risk of recession, and we've had rates pulling back since October, when they got a bit above 5.25 on the 2-year. Here we are today at 4.56, almost 75 basis points lower. Jay Powell had the opportunity to push back on that and just insert a little bit of hawkish language, try and get yields up, do his job for him and get inflation down. However, his tune is continually changing as we get closer to the election, actually sounding a little dovish, insisting they'll cut rates this year. He desperately wants to cut rates, and saying even though they want inflation to cool further, it doesn't need for the measure to hit its 2% target in order to cut rates. So what you're seeing is a bit of pivot in his language, setting the stage to remove that 2% target and becoming more flexible, as they say. And the closer and closer we get to the November election, the more controversial it's going to become, and seen as politically driven, him cutting rates. When we got risk assets ripping to new all-time highs, along with meme coins, companies that lose billions of dollars, core inflation still around 4%, shipping and cargo rates ripping up, some internal measures of inflation having flatlined for 6 months, if not ticking higher. All that doesn't matter. Looks like we probably will get that cut in June, because he really does want to cut at least once or twice before we go into November. And so we're all going to have to get used to living in a world with structurally higher embedded inflation. Because if he really wanted to get it down, he wouldn't be talking about how badly he wants to cut, but rather at least talking a little hawkish, given the possibility to another hike, and let the bond market do his job for him and really get inflation down to 2% if he wanted to. And so this is all the fuel risk assets need to keep pushing higher. No big problems in the economy. Jay himself saying there's no recession, we're still going to cut rates. That's music to the ears of the stock market, especially one that's already on a roll. And some risky pockets of the market, like regional banks exposed to commercial real estate, seems well contained. Fed's already been working with them for months. And even though New York Community Bancorp got slammed down today, the dip was bought. And we can see that on the daily chart here, this huge big spinning doji. Going down to the 15-minute chart, it was getting slammed down, looking to go towards a penny stock before being halted at lunchtime and gapping up a huge 124% when trading resumed at 2:30 this afternoon. And no doubt the Fed and other key officials are watching this closely to get in front of it, and that they did, with it gapping up on news that they raised more than $1 billion in equity investment, led by former Treasury Secretary Stephen Mnuchin. And so they've already plugged the hole in this one to prevent further contagion spreading throughout the sector and market as a whole. And just staying on the 15-minute chart, switching over the regional banking ETF, we saw the same price action. Huge spikes up on big volume. Just going out to the daily chart there, pretty much finished flat. So any other fires in the regional banking sector are going to get put out really quickly, just like we saw in NYCB. The Fed put is well and alive. The market knows that, leans against it, buys the bid, nothing to worry about. And so it looks like that risk has kind of been annihilated from the market, as like usual the Fed will step in and turn capitalism into socialism when it's convenient and not let things naturally die off, but rather artificially keep them alive. And if they have to use taxpayer money like they did in 2008, then they'll do that as well. Moving on to gold, we officially broke out to a new all-time high, likely trading up on the back of Powell's dovish talk, wanting to cut rates. That should help and bring the dollar down and make gold more appealing. However, not everybody's on board, even though we're breaking out to new all-time highs. Kind of done it in a backdrop of a lot of other assets. AI stocks, crypto is also doing it. Otherwise, it'd probably steal the limelight. It's kind of doing it under the radar a little bit here. But some people still saying, don't be enticed by the gold rally, as typically gold does well when other assets in the world are in trouble. However, maybe the market really is worried about things like Russian President Vladimir Putin recently warning us of nuclear conflict and the destruction of civilization if other countries send troops into Ukraine, like NATO is planning. So it's kind of strange to see a major asset rip up to new all-time highs. A lot of people really skeptical about it. And we can see that with assets under management and gold ETFs actually showing a strong historical divergence from the price of gold itself, with ETFs collectively holding 111 million ounces of gold back in October 2020 when it last ripped up to new all-time highs. But as of current, it's only at 82 million ounces of gold the ETFs are holding, down almost 30%. And just looking at the daily chart of gold futures there, nice strong rip on a 3 white soldiers candlestick pattern, well above average volume. There's the weekly chart, looking pretty bullish after we based there for the last couple of months. And going out to the monthly chart, looking bullish again. Looks like a huge ascending triangle pattern, which is currently breaking out here. If we can hold above these 2150 level an ounce, we could get a really good rip this year towards 2500 after it's pretty much been consolidating and basing for 3.5 years here. And so it might not just be Jay Powell really wanting to get rates lower, could actually be a bit of flight to safety and some big money, hedging some geopolitical concerns. Also got oil staying well bid, just below $80 a barrel as well. And maybe this talk of lower rates, geopolitical tension, could also be helping the run in Bitcoin. Seen as the anti-fiat hedge, it too's holding up here, just trading below all-time highs. Pretty strong rip in Ethereum today, actually found new yearly highs above 3,900. However, just going out to the monthly chart, that's still well off its all-time highs from that bubbly month of November 21 when it got up to almost 4,900. So it's a bit of a strange market with so many things ripping here. Stocks, bonds are ticking back up on lower rates, gold breaking out, international stock markets breaking out, cryptos, shipping and cargo rates. Seems like we're back in the everything bubble version 2.0. Even though a lot of consumers out there are still pessimistic on their situation and the economy at large, we can see that in the economic optimism index today coming in a little weaker than expected. JOLTS job openings printed a little weaker than expected, but the jobs market's still holding up pretty good, and we'll get a better look at this tomorrow with jobless claims, and especially going into the big one this week on Friday, unemployment rate expected to come in at 3.7%. And I'm not sure if it's a misprint. We probably won't know till tomorrow. However, if this is real, this is one of the biggest gaps I've ever seen in corporate insiders selling versus buying. Yesterday clocking in 521 sales versus 66 purchases. Corporate insiders selling like crazy here. And it's no surprise looking at the weekly chart, the S&P 500. They're typically contrarian as a whole, and we've been on this parabolic run now since late October. And if we were just to get a 50% pullback on this run we've had since then, that could take us down to 4630 on the S&P 500, and we could still be in a bull market. May find support there, then come up to new highs by Christmas. And for clues on that, we look at volatility risk premium. That's the difference between the VIX and realized volatility. Has ticked a little higher this last week to 2.91, still pretty low overall. And the option market still really on fire and lopsided. People still piling into calls on Nvidia, which could be helping its huge momentum run till it reaches what has to be a big blow off top at some point. And you can tell speculation's well and alive by the volumes we're getting for a midweek session, which usually comes in around 37 million contracts traded. Today it was 46.3, with 57% of them calls, almost half of them expiring in the next 5 days. Got a little bit of a bounce in Chinese securities today, along with clean energy trying to find support down here. International stock indices slightly higher on Wednesday, with the Nikkei still ripping. Best performing sectors today were IPO shares, semiconductors, and gold miners, still enjoying a big bounce off their support and catching up to the underlying, of which it's been lagging for quite some time now. And even though we've got growth ripping, we've got the defensive sectors looking good as well. Here's healthcare, consumer staples breaking out today, and utilities holding above their 50-day VWAP as well. Other hot stocks like Supermicro found new highs today. ARM Holdings still holding up. AMD breaking out to new all-time highs, and Taiwan Semi close to breaking out to new all-time highs. Was a good day for Palantir, ripping up almost 10% on the back of a new contract with the government. Same with cybersecurity stock CrowdStrike finding new all-time highs on the back of a good earnings report. And the other regional banks still holding up pretty good, knowing the Fed's got their back, and the big guys still ripping there as well. JP Morgan trading at all-time highs. All right, that's a wrap for today, guys. Calling up here, going into the jobs report. I'd say we'll get similar price action tomorrow as well, even though we may get another uptick in volatility. Option dealers pricing in potential movement on Friday. So far, they're saying we should get no surprises. Should be all good. 9-day VIX is only a little bit above the VIX 30-day. And looking at the most important stock in the market, it's gapped up and held today. Doesn't look like it's topping just yet, and seems as though $1,000 a share is almost inevitable, especially when we've got a dovish Jay Powell in this current environment that we're in, and him pretty much signaling to the market we don't really need inflation at 2% to cut rates. They're just going to do it anyway. So that's how it is. You just got to play it as it lays, and the momentum train rolls on. Thanks very much for tuning in to the Click Capital Daily Market Review and hitting that like button, and we'll see what sort of price action brings us tomorrow. Cheers.